Hello, and welcome to the Xperify Financial Derivatives course. Your instructor or guide is Frederick Michael, PhD. In this course, we will describe and examine financial derivatives, these consisting of forwards, futures, and options. We'll draw on real-world financial markets, data, experience, and applications, and reference some classical text that may be useful to you. The preparation you should have is a good grasp of statistics, at least Calculus 1, and maybe even experience with power series, partial differential equations, and stochastic calculus. In fact, that would be very useful at some point, even if you don't have that yet, especially the stochastic calculus. You should perhaps brush up on that or look it over. Also, a lot of this work is performed in the financial markets in the real world using computation, which means numerical solving of these equations, which are usually not possessing of closed form or exact solutions. You can just plug in numbers. So that's also a good skill to have relative to the financial derivatives course and its application in markets. So the course will take you from the concepts of financial contracts, such as options, derivatives, forwards, etc. Show you what the underlying market's behavior is and how a secondary instrument, such as a derivative, and that's what the name means, is derived from an underlying market's financial dynamics and written upon that, what that means and how that works, what the risks are, how they're traded. Briefly, there is a huge body of work related to and which discusses how to trade options, for example, what the strategies are, where these strategies came from, what they're used for. So we will discuss forwards, futures, and options, what they are and how they come about and how they're used. And we'll talk about the macroscopic evolution of financial derivatives. That's, again, how they're traded, what their profit and loss profiles look like, how they compare to the concept of insurance. And then we'll also start talking about hedging strategies and how the derivatives are used in hedges. Hedges are what the word means. You hedge against a possible downturn or a catastrophe, things like that, but as related to financial markets. And then we'll go through what uncertainties exist in financial markets, briefly again, what the uncertainty sources are, how that is risk, whether it's real, quantified, or it's perceived, subjective, and bias. In underlying markets, for example, to clarify that, an underlying market could be the Microsoft Corporation's fluctuating prices stock index in an index, and an option, a derivative, could be a call option or a put option, which are contracts to buy or sell the underlying stocks at a fraction of the cost and across different time horizons and risk appetites. And then we'll talk about systematic and deterministic trends. Yes, markets look like they're completely random, but they're not. There are known trends that occur. Some are seasonal, some are regulatory, and we'll also cover those briefly. Short and long-term trends, and also trend following, which is somewhat of a different concept. Trend following means could mean a large body of people, traders, financial market investors, and speculators that perceive a trend and will follow that trend. And that is the so-called herd mentality and response of financial traders. And we'll mention that also. And then we'll move to the mathematical quantification of uncertainty. And that is by, for example, the statistics and the stochastics. And we'll talk about the random walk, which is the quintessential stochastic evolution or trajectory concept. And from that, the randomly distributed variables and how they're either discrete or continuous. And that means discrete is point by point across different time increments, for example. And continuous is they're approximated by continuous equations. And how these averages are performed either for discrete or for continuous variables, what these averages mean, and how they are implemented. Also, we'll cover quite a bit of the notation that's used, and at least define it, if not use it. So these random walks and random price trajectories, these stock market fluctuating graphs that we see, have statistics, and for each one of these trajectories, the price variable, say, or the volume variable, etc., will have a statistical distribution. So we'll talk about these distributions and their properties, what kind of distributions are used by practitioners in financial markets, what optimal distributions are as applied to these price variables, and why they're not necessarily the traditional statistics that are applied. And I'll clarify that also. For example, Gaussian normal distributions are not quite accurate for describing price statistics. You need, or a more accurate distribution would be to apply power law distributions to real world markets and prices. And that has been done over the past couple of decades, more so than previously. And we'll talk a little bit about that. So we'll also discuss the frequency of occurrences of, say, increments of these trajectories, histograms where you bin these increments, and how envelope functions of these histograms, where you fit a distribution or a function on top of a histogram, is actually the probability density function of statistics. And how when at a different time slice you perform the same, and then again at a different later time slice you do the same, that is in effect a discrete version of the evolution of the PDF, or the statistical distribution in time, which the partial differential equations, such as example the Black-Scholes equation we will get to, is actually describing. We'll cover some of the statistics, exponentials, when squared variables. These are Gaussians, normal distributions. There are variations to that, log normals, which have been famously used even in the initial or traditional derivation of the Black-Scholes formulation of derivative pricing. And then more recently, the squeezed or Q exponentials, or power law distributions, and similar power law function distributions, for example, in gamma and so on. So we'll then be talking about the very important problem of outliers, or so-called fat tails, where there is a significant probability of a large or extreme event to occur. And we know this occurs all the time in financial markets. We have crashes and downturns and so on, large deviations from the small fluctuations, where then it goes, in a sense, haywire and starts fluctuating wildly with large changes. So the probability of these occurring, they're infrequent, but they're significant, and that's very important towards preventing losses in real-world applications and investments in financial markets. So the quantification of these outliers, for example, can be made straightforwardly by applying power law statistics that then have these heavy or fat tails and will quantify that risk, or at least include it in your statistics when you're describing the underlying risk that's associated with the fluctuations or the randomness of the underlying asset that then you're writing derivatives or options or futures, etc. upon. And we'll talk about the expectation values, what an observable is. An observable is an averaged, many times averaged, same variable. For example, if you look at a stock market price graph, you'll see a random trajectory fluctuating. That is just one trajectory. At any given point, the price at that time t, if you were to actually describe it as an observable, you would need hundreds and hundreds, if not more, trajectories that then you average at that time slice for. To describe it properly as an observable, as an averaged quantity. This can be a statistically weighted sum or integral, where there's a probability distribution weighting as a weight of that variable, or it can be a discrete sum where you sum and divide by the total. These are the two types of averages or averaging that we perform to obtain observables. And we'll cover, just for completeness, how statistics and the derivation of statistics can be made, or how that is related to information theory. For example, information measures can be minimized or extremized to obtain, given constraints of the known observables, what the statistical distributions relevant are. And there we will use variational principles in derivations of the Black-Scholes equation, and as mentioned, the proper statistics, both the traditional log normal used by Black-Scholes, and we will mention several times the power law, or more accurate statistics that are needed to actually accurately describe the underlying stochastic evolution, as well as the overlying or secondary market derivative options, etc. contracts. So we'll be talking then about these trajectories, and these trajectories, stochastic random walks, are described well if you include properly the fat tails and the squeezing, the bunching of small increments, and yet the significant occurrence of outliers by stochastic differential equations, and we'll talk about the Ito-sense ones mostly. There is another formulation by Stratanovich, but we will not really cover that. And then from that, we will talk about the partial differential equations that are equivalent descriptions, but on the macroscopic scale, on the statistic scale rather than the stochastic scale, of the system, or in this case, an underlying fluctuating priced stock. And then we'll start talking about portfolios, how these are formulated. A portfolio of assets, for example, consisting of options and consisting of stocks. That's our archetypal system and portfolio that we're going to be talking about. All others are, in a sense, similar. And from a portfolio and how we wish the portfolio to evolve at a known rate, for example, we can obtain the Black-Scholes equation, which is a backwards Fokker-Planck type partial differential equation. And we'll talk a bit about that and how the derivation and what the derivation implies as far as the underlying, the statistics used, and the final form of the Black-Scholes equation, and how it's solved and what exact solutions exist, as well as what numerical solutions must be performed to obtain results or or pricing for other cases where we're not using the very simplistic case. And therefore, we'll be talking about the fixed exercise time, European-style Black-Scholes equation and options, And then also we will have to talk about the American style arbitrary exercise time options that are also a variation on that more simple case of the European style fixed exercise time. And we'll solve the European style option and discuss what solution methods exist for modeling American style options. And we'll mention some of the tools used, again, by options traders. For example, the Greeks, which are rates of change of price, of time decay of the option, and so on. And we'll also cover briefly the trees or discrete branching processes approach to modeling options and derivatives, and how these then converge to the, for example, Black-Scholes partial differential equation in the continuous limit. So if you have a discrete process that's modeled computationally, probabilistically, in the continuous version of that, or approximation to that, we obtain partial differential equations. And there's a regular and rigorous way where we can connect the two, and we'll also briefly cover that.